Hey everybody, welcome back to the Wealthy Idiot Show. My name's AJ, and before we begin, make sure to go press, smash, smoosh that like button for the YouTube algorithm. And for a reward, here's a picture of a baby turtle. One of the Federal Reserve's real-time models for tracking gross domestic product, GDP, is showing negative growth for the second quarter of 2022. That means that for the second quarter in a row, quarter one we saw negative growth, now quarter two we're seeing negative growth. That means that we are most likely in a recession. We won't know for sure until the experts tell us next month officially that we are in a recession, but for those of us down here on the ground level, we can all pretty much see that we're not doing too hot in terms of what's on the shelf and how much that stuff costs. So now that the Federal Reserve is finally tracking that we're in a recession, we're seeing all kinds of interesting data. For June, we saw job growth slow down. So job growth is still increasing, but June, it's increasing a little bit less. That's not ideal for the future. It means that businesses are kind of strapping up a little bit, deciding what they're going to do, and they don't want to take too much on that they may regret if we do actually see a recession, or probably worse. Furthermore, America's savings rate is dropping to all-time lows. We're seeing them pretty much spend their savings to lows not seen since 2008. That would indicate that people who maybe aren't in the job market currently, who are living off of savings, are slowly running out of money. And a lot of people who maybe had savings in case of emergencies are using them up. People aren't continuing to save more, which means they're living more paycheck to paycheck because of the inflationary rates and the cost of everything in order to survive. To top that off for every normal person out here, the inflation rate was reported at 8.6%, which is the highest it's been so far since we've started this recession. However, real inflation is probably closer to 16 and 17%. If you haven't tuned into the show before, you might not have seen that the way we track inflation has changed from the 1970s to today. So when you're looking at a chart of inflation during the 1970s showing 13 to 14% inflation as a peak, and today it's at 8.6. Technically speaking, that's not true. We changed the way that we track inflation to make it look a little bit better for the people in charge. So really, if we tracked inflation the same way as we did before, inflation is actually closer to 16 and 17%, which makes sense for those of us paying gas prices, food prices that we're continually going up, including and especially meat. This would indicate that we might actually be worse off today than we were in the late 70s when the giant recession hit. We are also continuing from our problems with the pandemic and 2020. We still have supply chain issues. This could be caused by wars overseas, regulation and taxation at home, and residual supply chain issues from the pandemic. That's reducing the amount of supply of product, making it harder for manufacturers to produce, which is causing a shrinkage of our gross domestic product as well. All of these things have caused consumer confidence to drop to a 16-month low. We're seeing people start to get a little panicky about what's happening. Their confidence in the market is getting a little bit low. And technically that would mean we should see a contraction of spending. People should be a little bit nervous about what's happening and they should pull in and not spend as much. But like we pointed out, savings is at an all-time low. This is putting people in a difficult position where they have not a lot of confidence in the markets, and they also don't have a lot of confidence, or they don't have a lot of money saved for this disaster. This could end up being a lot worse than just a 2-quarter recession. It's starting to look like this may land us into something bigger, maybe a longer term recession than we originally thought, and some economists are even saying the next Great Depression. Even Paul Krugman, economist for the New York Times, who originally said that we are about to see the biggest economic boom that he's ever seen. He called it the Biden boom, and he said the outlook may be better than we possibly think. He's even having to retract that by stating in an article last week, quote, "Mainstream economists are currently divided between what is now widely called team transitory and team persistent. Team transitory, I'm cutting in here real quick for those of you who don't know, transitory just means that inflation is temporary, that we'll see a little blip of inflation and we'll go back to normal. And persistent would mean that this inflation is going to be a consistent rise for a while." So back to the quote. "Team transitory, myself included, has argued that we're looking at a temporary blip, although longer lasting than we first expected. Others, however, warn that we may face something comparable to the stagflation of the 1970s. And credit to where credit is due, so far, warnings about inflation have proved right. While Team Transitory's predictions that inflation would quickly fade have been wrong. So even our friend Paul Krugman, the great economist at the New York Times, has to admit that maybe this isn't a temporary problem. Maybe this is more serious than he originally gave it credit for. And we're starting to see the impacts of that on normal Americans. So all of this news sounds a little bit scary. It kind of points to that, I'm not an economist myself. I can't predict the future, but it's starting to look like maybe the temporary problems that we've been told were temporary now for 2 years and have been around for a while may continue to persist for a little while longer. And hopefully it won't turn into something like a Great Depression, but that's not totally out of the picture, which is a little bit scary, and it could mean a huge impact for a lot of people. So the question is, what do we do about it? How do we prevent ourselves from being damaged by whatever happens next? And here's what we recommend at The Wealthy Idiots. Number 1, fill your emergency fund and save as much as possible. Whatever you think you might need in order to survive an extended period of time without a job, or any kind of life-changing event like having to go to the hospital, you should be saving in order to prevent yourself from having to dip into investments or take out debt in order to be successful. That money is going to protect you so that you don't end up being in a place of just great damage in the middle of the worst time possible economic. Number 2, find more sources of income. While the job market doesn't look too bad right now, companies are still kind of scrambling to find employees. That may switch coming pretty soon as the economic numbers come out that our GDP isn't so great and stuff isn't looking up. Companies might tighten their belts and not hire new people, and we may see rounds of layoffs. If that's the case, you're gonna want extra income. Extra income also means it'll be easier to save, put money in case you do lose your job, and cover yourself in case of an emergency. Number 3, pay down high income debt as soon as you possibly can, especially if it's a small amount of debt. Any high income debt you have to get rid of. That's going to really drag you down if you lose your job. It's going to be something that you have to pay, but furthermore, if we can get rid of it, it means extra money that normally goes towards that debt can now go towards savings and investments. Number 4, now's the time to start putting off major financial decisions like major purchases, cars, jewelry, trips, all of those things. Right now might be not a great time to throw a bunch of money down on something exciting. Instead, put some of that money into your emergency fund just in case something bad happens. The worst case scenario would be you go out and get a new car with whatever cash you have in your bank account, and then you lose your job the next day and you have no way of translating that car into the cash that you need in order to survive. And finally, definitely not last, number 5, invest whatever it is that you don't think you need for your emergency fund or extra savings. Those investments right now are going to make you wealthy in the future, because as the economy is dropping and as you continue to invest, once the economy starts coming back on the tail end, you're going to see growth like you've never seen before. Wealth is made in bear markets, not in bull markets. And we're in a time now where investing is more important than ever. Throw as much money in as you possibly can, and you're going to see great benefits on the other side. That's all I have for today. I'm sorry the news isn't super great. Everything is kind of looking down. The good news is there are ways to prepare and protect yourself and your family, and now's the time to really get into this investment cycle and produce long-term wealth. Remember, we're not looking at what we produce tomorrow. We're not looking at the numbers the next day. Stuff is going to fluctuate and drop. Right now, everything is a little bit weird. We're looking at the 30-year time frame and beyond. We want to see continual wealth growth for an extended period of time, and right now is the time to get in when everything is on sale. So thank you so much. I appreciate it. Make sure you like and subscribe, and until next time, I'll see you later.